Small businesses every year. This makes them the largest Welcome to another online training session with Impact VTech. Discussing the basics of government contracting, Part 1. The U.S. government purchases billions of dollars of goods and services from small businesses every year. This makes them the largest purchaser in the world. Chances are good that whatever your business produces, the government buys it. In an effort to level the playing field, the government has issued goals to encourage selling to underutilized business segments, including small, woman-owned, small disadvantaged, service-disabled veteran-owned, and hub-zone businesses. As you can see here, a certain percentage of the government's purchases are set aside for the businesses that fit under these categories. Small disadvantaged, service-disabled veteran-owned. In order to determine what constitutes a small business, the Small Business Administration assigned a 6-digit North American Industry Classification Systems code, or NAICS code, for groups of products and services that are alike. They then assigned an average sales number or employee limit on each code to determine what is small. For instance, a small flooring contractor would be considered a small business if their average gross sales were less than $14 million. But a small retail bakery would need to have less than 500 employees to be considered a small business. A list of these NAICS codes and their corresponding size restrictions can be found at the Small Business Administration's website, sba.gov. Acquisitions that have an anticipated dollar value exceeding $3,500 but not over $150,000 are automatically reserved for small businesses. Other contracts may be set aside or include set-asides if they fit the following rules: the Rule of Two, the Non-Manufacturing Rule, or subcontracting limitations. The Rule of Two applies to acquisitions over $150,000 in which there can be a reasonable expectation that offers will be obtained from at least 2 responsible small businesses. These contracts should then be set aside for small business. The non-manufacturer rule sets aside small business acquisitions that are not for construction or service-related contracts. They must utilize a domestic small business manufacturer. The SBA may issue individual or class waivers to the non-manufacturer rule if no small manufacturer exists. This rule does not apply for contracts under $25,000. The subcontracting limitations apply to contracts set aside for small businesses when the contract amount exceeds $150,000. For the service industry, at least 50% of the contract costs for personnel must be expended for employees of the small business. The business must perform work at least 50% of the cost of manufacturing the supplies, not including the cost of materials. For general construction, the businesses must perform at least 15% of the cost of the contract, not including the cost of materials with its own employees. We will now talk about the various preference programs for small businesses, starting with the Hub Zone program. Hub Zone stands for Historically Underutilized Business Zone. The goal of this program is to encourage growth and business in areas that are underutilized according to the U.S. Census. Benefits to Hub Zone businesses include competitive and sole source contracting, as well as a 10% price evaluation preference when bidding against large businesses. There is also a 3% contracting goal for government agencies to meet. In order to qualify as a Hub Zone business, your principal office and at least 35% of your firm's employees must reside inside a Hub Zone, and at least 51% of the business must be owned and controlled by a U.S. citizen. A map to show which areas qualify can be seen at the following link. The Woman-Owned Business Program has a 5% contracting and subcontracting goal. This program only applies to certain industries that are listed by NAICS code on the SBA website, sba.gov. To qualify as a woman-owned small business, the firm must be 51% owned and controlled by one or more women who are U.S. citizens and whose ownership is direct. The woman or women must also be in control of and manage the day-to-day operations. The qualifications for the economically disadvantaged woman-owned business is all of the terms listed for the woman-owned, along with the personal net worth of less than $750,000, an adjusted annual income of $350,000 or less, all assets that do not exceed $6 million. The WOSB and EDWOSB programs can either be self-certified or certified by a third party. To self-certify, you will need to upload the required documents into SBA's online system, GLS. To be certified by a third party, you may contact any of the 4 approved organizations listed on SBA's website. Those organizations are located in Texas, Florida, and Washington, D.C. Veterans and service-disabled veterans may qualify for their own preference program if they are at least 51% owned and controlled by a veteran, are full-time in the business, control the day-to-day operations of the business, and the veteran must hold the highest office and the ownership of the business must be direct. Businesses must self-certify by completing the Reps and Certs section of the System for Award Management, or SAM, registration. There is a 3% prime and subcontracting goal for this program. The U.S. Department of Veterans Affairs has its own program for veterans called the Veterans First Contracting Program. Only veterans and service-disabled veterans are eligible and must be certified by the VA. Benefits of the VA include competitive and sole source contracts, as well as a 10 to 12% goal for VOSB and SDVOSBs within the VA. If you are a veteran and are looking for help with the certification process, contact Tanner Olson with Impact PTAC, as he is a certified veterans counselor for the Veterans First Contracting Program, and he can help you prepare for the certification. Contact information is listed at the end of the presentation. We will now move on from talking about preference programs to subcontracting. Subcontracting can be an excellent opportunity for small businesses, especially if you're new to the government marketplace. It can prepare you for contracting and help you to build a resume with government projects. If you are looking for subcontracting opportunities, the SBA has a database called Subnet that can be found through sba.gov. You can also find subcontracting opportunities by following the Interested Vendors tab and Awards on FBO or FedBizOps. Under the Subcontracting Assistance Program, when a prime contractor receives a contract greater than $150,000, they must agree to provide small businesses with the maximum practical opportunity to participate as subcontractors. This process is negotiated between prime contractors and contracting officials and opens the door to many opportunities for small businesses. Subcontracting plans start after $1.5 million for construction and $6.5 million for all other industries. There are 3 types of plans: individual, master, and commercial. Here is a breakdown of the subcontracting goals in relation to preference programs. Small, disadvantaged, and women-owned businesses each have 5%, and service-disabled veterans and HubZone each have 3%. The final section that we will cover is in regards to how the government purchases goods and services from businesses. Depending on the contract, the government will decide what the qualifications are for a supplier and will award it according to those standards. All of the buying procedures may be found in the Federal Acquisition Regulations, or FAR. The different methods used are credit cards, simplified acquisition procedures, sealed bidding, contracting by negotiation, and consolidated purchasing programs such as GSA, GWACS, etc. The government will use a credit card on purchases under $3,000. Unlike most purchases and contracts that require multiple offers and competition, these contracts do not require that there be competition and are usually sole sourced and are not closed off to large businesses. It is important that your business accept credit cards, as 70% of purchases are made with a credit card. The simplified acquisition threshold is used for purchases between $3,000 and $150,000. This process simplifies and streamlines the process for small businesses and contracting officers. Sealed bidding is a competitive buying method for specific and clear government requirements in which the government issues an invitation for bid, or IFB. The contract is awarded to the lowest bidder who is fully responsive. Negotiated contracts are a very common procurement vehicle for contracting officers. They will issue a request for proposal or request for quotation for products or services that are being sought. This buying method is usually used when highly technical products or services are being sought. As always, if you have any questions, please contact your local PTAC. The contact information is listed below. Welcome to another online training session with Impact PTAC. Today we will be discussing the basics of government contracting, Part 2. We will start with contract types. There are 6 basic types of contracts, including fixed price, cost reimbursement, incentive contracts, indefinite delivery contracts, time and material and labor hour contracts, and agreements. We will begin with fixed price contracts. These are the most common types of contract, and the price of the contract is set before the project is started. In the form of firm fixed price with an economic adjustment, and fixed price incentive. Cost reimbursement contracts provide for payment of all allowable expenses to the extent prescribed in the contract. These contracts establish an estimate of total cost for the purpose of obligating funds and establishing a ceiling that the contractor may not exceed except at its own risk, without the approval of the contracting officer. Cost reimbursement contracts are normally when uncertainties involved in contract performance do not permit costs to be estimated with sufficient accuracy to use any type of fixed price contract. Incentive contracts, as described in this subpart, are appropriate when a firm fixed price contract is not appropriate and the required supplies or services can be acquired at lower costs and in certain instances with improved delivery or technical performance. Incentive contracts are designed to obtain specific acquisition objectives by doing 2 things. First, by establishing reasonable and attainable targets that are clearly communicated to the contractor, and secondly, by including appropriate incentive arrangements designed to motivate contractor efforts that might not otherwise be emphasized and discourage contractor inefficiency and waste. Indefinite delivery and definite quantity contracts, or IDIQs, provide for an indefinite quantity of services for a fixed time. These are used when the agency can't determine above a specific minimum the precise quantities of supplies or services that the government will require during the contract period. Streamline the contract process and speed up delivery service. IDIQs are most often used for service contracts and architect engineering services. Awards are usually for base years and option years. Places delivery orders for supplies or task orders for services against a basic contract for individual requirements. Minimum and maximum quantity limits are specified in the basic contract as either number of units for supplies or as dollar values for services. Time and materials, or T&M contracts, provide for acquiring supplies or services on the basis of direct labor hours at specified fixed hourly rates that include wages, overhead, general and administrative expenses, and profit, as well as actual cost for materials. A T&M contract may be used only when it is not possible to accurately estimate the extent or duration of the work or to anticipate costs with any reasonable degree of confidence. 2 main types of agreements: the Basic Order Agreement, or BOA, and the Blanket Purchase Agreement, or BPA. A BOA is a written instrument of understanding negotiated between an agency and a contractor that contains 3 things. First, terms and clauses applying to future contracts or orders between the parties during its term. Second, a description, as specific as practicable, of supplies or services to be provided. And third, methods for pricing, issuing, and delivering future orders under the Basic Ordering Agreement. A Basic Ordering Agreement is not a contract. A Blanket Purchase Agreement, BPA, is a simplified acquisition method that government agencies use to fill anticipated repetitive needs for supplies and services. BPAs are essentially a charge account set up with suppliers. They help trim the red tape associated with repetitive purchasing and make repeat purchases easier for both sides. A multiple award task order contract is an IDIQ type contract with multiple awards used by the military for acquiring facility design, construction, and maintenance services. Several firms are awarded or allowed into the MADOC, and then when task orders are made through the MADOC, only those businesses are allowed to bid. The Federal Acquisition Regulations, or FAR, is a substantial and complex set of rules governing the federal government's purchasing process. Its purpose is to ensure purchasing procedures are standard and consistent and conducted in a fair and impartial manner. To have success within the federal government arena, it is critical that they have an understanding of the FAR. Some of the key parts of the FAR are included on this list. In order to be successful in government contracting, there are several steps a business must take. Here are a few of those steps which we will go through in more detail over the next few slides. The first thing you will need to do is register with Dun & Bradstreet to get a DUNS number for your business. This number will be used to identify your business for the purposes of contracting and is necessary to fill out your SAM registration, which we will discuss on the next slide. Getting a DUNS number is a free process and can be done by going to the following website. Make sure when completing this registration that you use your company's name exactly how it's listed on your tax records. If not entered correctly, it will cause problems when registering for your SAM account. The next thing that you will want to do is define your products and/or services. The federal government uses a system called the North American Industry Classification System, or NAICS, to identify products and services. You can search for your codes at the following website. The System for Award Management, or SAM, is a database of companies registered to do business with the government, and it is required that you register before you can receive a contract. The correct website for SAM is www.sam.gov. Be aware that there are spam websites that look similar but want to charge to register your business. The SAM registration is free, and you will want to make sure that you are at the correct website. Some of the following information you will need to complete the registration is your DUNS number, tax ID, banking information, specifically checking and routing numbers, NAICS code, and general business information. Many businesses have trouble with the SAM registration, so please give Impact PTAC a call if you need assistance. The SBA profile is a database used by government contracting officers and prime contractors to find potential businesses for upcoming contracts. Most of the information on SBA profile is pulled from a company's SAM profile, except for the capabilities narrative, keywords, and bonding levels, which need to be completed by accessing your SBA profile. This is done by logging into your SAM registration and clicking on the SBA profile link on the second to the last page of the registration. Many companies are unaware of SBA profile and don't complete it, but it is very important because it is the primary website where agencies do their research to find capable businesses for future contracts. The Dynamic Small Business Search tool is used to search the SBA profile database. This is a great place to search for competitors or to find examples of capability statements or keywords to use in your own profile. You can conduct searches by state or county, preference programs, keywords, NAICS codes, and more. This is a great research tool that we suggest you use before completing your own SBA profile. Marketing to agencies and contracting officers can often feel overwhelming because of the enormous size of the federal government. In order to effectively market your business, it is necessary to research which agencies have a history of buying your products or services. That is by using the Federal Procurement Data System, which can be found at fpds.gov. Another option is to have Impact PTAC create an in-depth marketing analysis for your business, which will allow you to focus your marketing efforts. You'll also want to find conferences and matchmaking events that agencies are attending so that you can meet directly with their representatives. Impact PTAC sponsors conferences like these, so make sure that you contact us and get on our mailing list. Capability statements are an integral part of marketing to government agencies. Contracting officers are often inundated with marketing materials, so it's important to keep your capability statement clear and concise. Information should be included in an easy-to-read format. Specific capabilities and skills, DUNS number, makes codes, cage code, past performance history with specific projects, awards and commendations, and the resumes of key management to show legitimacy. For templates and assistance with your company's capability statement, make sure to contact Impact PTAC. It is important to do your research on which agencies buy your product and where they buy it. Some agencies will split contracts up to be underneath the $25,000 threshold so that they don't have to post it publicly. Others will order most of their goods and services from GSA, and some will simply post the contracts on FedBizOps. Research on who, when, and where agencies buy can be done on sites like FPDS or through agency forecasting sites, which can be found through acquisition.gov. Good research leads to effective marketing. Opportunities. One of the main places to go is FedBizOps, which can be found at fbo.gov. Government solicitations over $25,000 are required to be posted on FBO. It is important to sign up for a free vendor account to register as an interested vendor on projects and watch opportunities. If you would like more information on FBO and how to register, you can watch our other FBO training videos in our members module. You will also want to subscribe to Impact's free bid matching service. Impact will assist you in creating a search profile which will cross-reference several federal, state, and local contracting websites. An email will then be sent to you every day there is a match. This saves you from having to spend the time going to different websites and manually searching for opportunities. A good way to get your foot in the door is to subcontract with a large company holding a contract. These opportunities can be found by contacting award winners from FBO or by looking through the posted subcontracting opportunities on SBA's subnet site. There are many great resources online, whether it is from SBA, SBDC, or PTAC sites. Use these to your advantage and partner with a local PTAC to get help with everything from registrations to certifications, marketing, and proposal development. Here is a list of resources for you to use. Feel free to pause the video and write down any of the applicable hyperlinks or email us for a list. If you are a North Dakota business and you have any questions about government procurement or need help with registrations, feel free to contact either Darren Pirius or Tanner Olson at Impact PTAC. We look forward to working with you. Thanks for watching and have a great day.
Basically set up your company so that maybe you can do the work for $75,000. That's why it's very beneficial for you as a buyer to have a firm fixed price job. It also gives you incentive to control costs, improve profits, and ensure that you meet your deliverables or milestones. Pricing on firm fixed price is typically less complex. So what are the risks? Some of the risks for these types of contracts is that you as a contractor assume full cost responsibility. So if you bid $100,000, you need to basically sure that your labor and materials are all going to fall under that specific funding value. Obviously, the closer you get to that ceiling, the less profit you make, and then ultimately, if you go over that ceiling of $100,000, then you're working pretty much at a loss. In these days, all RFPs, or most of the RFPs other than in the Intel industry, are all lowest price, technically acceptable type RFPs. So these fixed price contracts demand high performance and schedule risk for the contractor. And you really can't overlook recouping your indirect costs that are associated with this type of contract. So if your indirect costs, what that means is that if your indirect costs fluctuate year on year or even on a monthly basis, we'll just take fringe, for instance. If you bid it at 30% and your fringe fluctuates 35, 40%, you really can't recoup those types of costs. You just have to build it in within the funded value that the government gives you. Okay, so the best practices for these type of contracts in the bidding process: know all the impacts of the contract requirements and specifications. Basically, read the cost volume, read the RFP very carefully. Include well-defined accepted criteria to know when tasks are complete. So if you have milestones within your fixed price contract, or if you have deliverables, know when exactly those are completed. Be sure work can be completed for your proposed hours and costs, and obviously prevent any subcontractor overrun. And really what that means is, if you're a prime that was awarded a firm fixed price job and you have some subcontractors on there, sometimes your subs could be offered a T&M type work or even a firm fixed price. On the T&M side, you can easily overrun your costs because you're offering your subcontractors a time and material basis. So you as a prime, you have a firm fixed price job. So sometimes subs can kind of take advantage of that, and obviously they're going to bill you for their costs, which will impact how much profit you make on the job. So be wary of that. The next one we'll get into is T&M contracts. T&M is really suitable for use when the seller can't accurately estimate the extent of the work, the duration of the work, or really anticipate any cost with a degree of confidence. More defined definitions can be found in the FAR section 16.601. And some of the risks that are associated with time and materials, the profit percentage for time, very good. At the same time, you can really kind of hurt yourself in a time and material type basis because of what you originally bid. So during the original RFP or the cost volume pricing development, you might already have an in-house resource that you want to go ahead and bid out. And fringe, overhead, G&A, put in a profit percentage, and you end up with a specific bill rate for that first year of your contract. Leaves, and he was, making $80,000, and then you find another replacement, but that person, demands $120,000. You're stuck with that bill rate. You can't go back to the government and say, by the way, I've added someone more expensive. Can I increase my bill rate? So essentially, you're stuck with the bill rate. That's a risk within T&M contracts. Now, vice versa can happen. You can have you bid an $80,000 employee, that employee leaves, and then you find someone that can do the work for $70,000. That greatly increases your profit on the bill rate. So we already talked about the internal rate changes will increase labor costs, reduce profit over time, and they can be pretty difficult to staff projects. So if the government comes back to you and says, hey, I need another resource, this will be a new job description, how fast can you get that employee in? Well, there's a lot of negotiations that go on within that. You can't just, for instance, for a firm fixed price, you can just add in another person with a practices. Propose higher than normal rates. A good use is some type of resource website such as salary.com that can take your geographical location and say, okay, well, a Java developer makes this in your area of the country, and you'll be able to base your rates off of those average or high-level salaries. Ensure forward pricing rates cover average of future costs. We'll get into provisional rates later in the slide, but essentially you want to what your company or what your financials will look within the year or the next year, so that you can anticipate what that's going to cost the government, and then you're going to give them those provisional rates and build your labor rate off of those provisional rates. And then another best practice for time and material contracts are, a lot of times those labor categories have certain limits in the amount of work hours that are proposed. So instead of limiting the actual labor category hours, where you could potentially shoot yourself in the foot, try to limit total hours of the job, not by labor category. Okay, so next one we'll get into is cost plus fixed fee type contracts. Used only when uncertainty is involved and contract performance do not permit costs to be estimated with sufficient accuracy to use. The government has a significant amount of work to be done, but they can't really distinguish how much it's going to cost. So in that case, they ask contractors, hey, give us a bid, let us know how much you can do this type of work, how fast, and then they usually pick based on the price. Again, we'll talk about profit. Literally on the cost plus fixed fee type work, your profit is limited between 2 to 8%. So any type of overrun in your indirect rates really shrinks and puts you as a contractor at risk for very minimal profit or no profit at all. The benefits. There are some benefits to cost plus work. One is that it really gets you on the DCA map. That can be a benefit, and that can be actually a disadvantage for a company as well. But it gives you almost like an ace in your pocket, saying that, hey, I've been reviewed by DCA, I've gone through a system audit, and DCA's found my company adequate. That's an advantage. You also get to recruit all of your allowable direct and indirect costs associated with the contract. So only if, and I should have put an asterisk in here, only if your rate exceeds what you proposed. If you propose 30% and you ended up the year at 35%, you can essentially go back to the government if there's funding left over and say, I've had an overrun in my fringe of 5%. I'm going to go ahead and bill you the difference. Government, most of the times, will go ahead and pay you that particular difference. On the other hand, if you bid 30% fringe and you end the year at 25%, you actually owe the government back money because more than what your fringe was worth, essentially. Also gives you some flexibility with estimating costs, and we can kind of get into that, what that means when we go into the provisional rates. So with some of the advantages, there are, I'd say, a lot of disadvantages for having cost plus work. The government is not obligated to reimburse contractors for costs. So the same scenario, if you bid 30% and you ended the year at 45%, let's say, the government's not going to pay you that difference. They might give you some of it, but if you just vastly bid inaccurately and you ended up 15% over what you bid, the government most likely won't reimburse you for that. have to notify your contracting officer if your cost estimates change. If you've had some unforeseen cost, large expense hit your company, you can usually go back to the contracting officer and say, hey, we didn't forecast this out. This is what it does to our rate. Can we adjust? Most of the time, the contracting officer will oblige. Subject to DCA audit, system audit, and financial audit. And you are subject to submitting what's called an incurred cost submission. So an incurred cost submission is basically a book that DCA uses of your financials. It has all costs associated with it, and they use that as their guideline for when they come in and audit your financials. They want to make sure that your costs are in line, that costs are being allocated out correctly, and that labor and invoicing that you are performing to the government are done correctly. It's essentially just almost like a CPA audit. And then lastly, you have to ensure that your costs with billings are in line with what you estimated. So back to fringe. If you estimated 30% fringe, that's what the government is expecting to bill for. You can't add in 32% one month, another month. It must maintain at that even 30%. So best practices. Watch contract costs and funding very closely. If you have an accounting system that's able to distinguish between targeted rate or provisional rate and your actual rate, manage right there, because you're able to monitor those costs. You're able to see where you're over or where you're under every month. Reason why you need to watch your costs is that you don't want to be too over and you don't want to be too under your proposed rate. Again, notify contracting officer of needed funding. Monitor your contract for scope creep. That happens very often in cost plus type work because the government is very unsure of the amount of effort that it'll take. So obviously, if the scope does change, you need to notify your contracting officer. Work off of provisional rates and adjust those rates each year. Notify PCA of any changes to your indirect rate structure. You could have essentially going after a cost plus type work and you're not building in, let's say, a material handling rate because now that you're offering subs some work, it'll probably lower your G&A. So some companies like to develop what's called a material handling rate. So if you develop a new rate and you've already sent in a bid, notify DCA and your contracting officer of those changes. And more likely than not, they'll go ahead and structure that contract. And then to piggyback off of that, no fee on top of fee. A lot of small to mid-sized government contractors, when they do get awarded a cost plus work, make this mistake. So in an instance where you have subcontractors, and let's say you offer the subcontractor a cost plus type work as well, build in the raw labor plus fringe and any other indirect burdens that they have, and then they're going to go ahead and put fee on top of their costs, right? So if the contract states you as a prime, you can't have, let's say you can't bid over 8%, typically what will happen if you don't have an advanced accounting system or you have an employee that truly doesn't understand cost plus work, a lot of times what happens is that those sub costs that you get, you're going to go ahead and have fee on top of that as well. So you'll have your labor plus your indirect rate burdens, maybe some ODCs, maybe some travel, and then you'll have your sub costs. Sometimes subcontractors will put 8% on top of all those costs. So essentially you have fee on top of fee. When that happens, it's a big red flag for DCA, and it could get you as a company in trouble. So cost plus award fee contracts are essentially the same. I'm not going to go through a lot of the same type of stuff. Essentially, it's the same, but there is a performance or achievement aspect to the contract. Government's still uncertain about how long it'll take, what the level of effort is, but they realize that, okay, well, I want a certain milestone to be reached. And if you as a contractor can achieve that milestone and achieve above and beyond what you proposed, more often than not, you're going to get an award fee, which ranges anywhere between 2 to 8% on top of your 2 to 8% that you did when you submit the RFP. So the benefits award fee may be earned in whole or part during contract performance. Usually they range anywhere between quarterly, semi-annually, and annually are for the award fee. Again, you can recoup pretty much all your allowable direct and indirect, and you have flexibility. So some of the award fee risks are that since you've been awarded a cost plus award fee type contract, you're not guaranteed that award fee. I know companies that I've dealt with that have been given 100% of the award fee. If your performance as a contractor is marginally acceptable or even unsatisfactory, chances are you won't receive an award fee. And again, the award fee determination is strictly on your contracting officer. And if they give you 1%, you can't appeal that. And then obviously, cost plus, any type of cost reimbursable type work, ECA audits, and incur cost emissions. So award fee best practices maintain satisfactory performance throughout contract. You can get the work done in less than what was the original contract value, that could result in an early award fee. And then same scenarios for cost plus fixed fee. Watch your contract costs and funding closely, notify your contracting officer of any changes, and work off of provisional rates or forecasted rates. All right, so we basically ran through some of the basic contract types, and we'll now get into pricing principles, pricing best practices, and why we price. I mean, obviously, you want to increase cash flow, you want to increase profits for your company. In some cases, you might want to go ahead and price lower for a certain RFP just to get that revenue growth. And obviously, in that type of scenario, you would want the revenue growth, the past performance in the industry or market that you're going into, and a piece of the market share. So some of the characteristics of pricing that are very important. Obviously have a clear identification and understanding of the task within the RFP. Broad participation in pricing preparation. Sometimes small contractors only have one pricing person doing the whole cost volume. That's a liability because there might have incorrect information. There should always be multiple people involved in the cost volume and the pricing preparation. Having the valid data available, and we'll get into primary sources for data and secondary sources for data. Have a standardized structure for estimating. If you use a budgeting tool, whether it's a spreadsheet or another application, try to standardize that for all your pricing on the RFPs. Recognize inflation. When you bid base year plus option years, make sure that you have an escalation factor in there, whether it's 2% to 3.5%, whatever you feel comfortable with. And recognize excluded costs and burden. Don't include alcoholic beverages and your overhead costs, for instance. And revision of pricing estimates for significant program changes. So if an RFP basically, completed your pricing, revise those things so that it gives you the best advantage as a company when it comes to the selection. So this chart here shows a primary and secondary where you can get information and data to complete pricing and your cost volume. Obviously, the primary side includes accounting records, reports, all of your historical database, so that you can trend out what your forecasted rates will look like, your labor distribution reports, for those on the advanced accounting system, if you have indirect cost reports printed out, those are good. If you maintain them on a spreadsheet, they work as well. They have in SMEs, recruiting, and technical basis are all really primary sources for pricing and developing the cost volume. And you'll notice that in the secondary column, some of those overlap, but then you have previous cost proposals, contract estimates, research papers, competitor intel. If you have a really good BD person in-house, a lot of times they'll know what your competitors' rack rates are, what they were awarded for a similar type of contract. Focus groups, red team, blue team within your proposal team, and surveys are all good sources of data. So major risks in contract pricing. This is where a lot of contractors get in trouble in pricing, and even though you might have a technical approach to the RFP, if your pricing is shabby and it has a lack of buyer understanding in the RFP requirements, or if you're trying to piece together pricing within a week to 2 weeks, these are all major risks, and for you as a contractor to not be awarded the RFP. Sometimes, and that's why it's really good to have that broad participation when developing the cost volume and pricing, because you could have one person could understand the language in the RFP one way, and another person reads it and it could be completely different. Deception. If you have a pricing person that's solely responsible for pricing, think or say, yeah, I've completed the pricing for you. I've used these rates. Come to find out maybe that the rates are completely different or they're incorrect. So that's why having multiple resources work on pricing is very important. And then last is the poor cost estimating and poor pricing practices. So with that, I'm showing you essentially how to build up your hourly rate. And in this case, it's really for a time and material type job, but it also gives you a way to come up with how much the total employee will cost, fixed price or cost plus type work. Okay, so this salary of the $48.08 is based on a salary of $100,000 employee working 2080 hours a year. And let's assume that the fringe is 32%. Okay, so you're going to take the 4808 times the 32%, and it gives you $15. Now you burden, when they say a fully burdened rate, then you're going to take your next indirect rate, which I'm assuming most of you all have an overhead rate. Some of you all might have multiple overhead rates. Depending on what type of overhead rate you're going to bid, you take in the hourly rate plus the fringe rate, and then multiply that by your overhead rate, and in this case, it's 24%, so it gives you another $15. So if you have G&A, which you all do, then you take a combination of the fringe, overhead, and the raw labor, case, we just use 10%, adds in another $8.50. So your total bill rate for the employee is $93.48. And you can take that and build that into your pricing matrix. So what I wanted to show you is that this is, let's say, you've already established provisional rates, or you want to work at actuals at the end of the year, and this is what you end the year at. So this is how you essentially build up a rate and figure out how much an employee costs the company. So in RFP and government contracting terms, rep rate is thrown around there. Typically nowadays, a lot of contractors and BD folks will say, hey, I need my rep rate to be around 1.6 or 1.5. Well, this is how you come up with your own rep rate within your organization. Assumptions are fringe, just using the same percentages. Fringe, overhead, and G&A. The calculation is 1.32 times 1.24 times 1.08 gives you a total rep rate of how much the employee costs you. This example is 1.767, and it's kind of in the middle towards the higher end of what's a good range to be in nowadays type RFPs. Intel work, you probably need to be a little bit below or right around 1.5. Housing, urban development type work, a higher range is okay, but that's a pretty good range to be in. It's a 1.5 to 1.8. So when you're able to come up with a fully burdened rate that includes fee, then you can throw in, okay, now my labor matrix has been completed. So now you can take the hourly rate, know what the hourly rate is, and throw in the fringe, overhead, and G&A to come up with a fully loaded rate. And in this example, that's essentially what the government would like to see. All RFPs have their own matrix that they want to use, but this is an example of what they'd like to see. They like to see how things are broken out, how you come up with fringe, if your calculations are correct, and how you come up with a fully loaded rate. So in some of these slides that we've been talking about, we're talking about provisional rate or forecasted rates, okay? Provisional rates are essentially towards the end of the year. You take all of your costs from either the same year or a previous year, and you combine the two, and you say, okay, my ended up the year at fringe at 30%. Well, I'm going after 3 RFPs that's going to increase my employee FTE count by 20 employees. So then you plug in those 20 employees, you know what their salaries are. You also plug in any costs associated with those employees, and figuring out what the revenue as well would be for those RFPs if you win. You can come pretty close to what your company is going to look like if you win those RFPs that you're going after. How it works is that, okay, yeah, you might not win one, but then you're going to go after another RFP, so it kind of replaces that. So you can pretty come close to what your company will look like. And in most cases, it lowers your rep rate when you develop a provisional rate. So if you're typically at 1.8 here, and let's say you want to go ahead and forecast out these rates this year, you might be at 1.67, 1.7. Is that, okay, you're giving the government forecasted rates, but at the same time, you have more of an advantage of winning that work. So the lower rates that you have, the more chances you have of winning that work. Anytime you win work, it decreases your indirect rates. So that's pretty much how that works out, okay? So they're really used for both pricing and billing on cost-plus type work. That's where the billing would come in. You have to reconcile your actual costs versus your provisional rate costs, either at the end of the year or when your contract ends. can be audited by DCA. You can always submit provisional rates. You don't have to have a cost reimbursable type work to submit provisional rates. You can actually just say, hey, I use provisional rates as a company to give you that edge when you go after an RFP. But DCA uses your provisional rate budget as a frame for reference when the auditors are reviewing either proposals or your billing. And they are used really for billing for your, and as mentioned before, pricing new work. Any change within your provisional rates when you have cost reimbursable type work, you have to have that data supported by either actual financial statements that have that rate change. Anytime you have a change in indirect rate structures, that could spark basically a red flag at DCA, and they can get back to blood question. So in this scenario, I'm showing you the difference between the actuals and the provisional rate. On the left-hand side, this is where you ended up the year at. Your fringe 30%, overhead 25%, and G&A at 9%. So as you can see, your wrap rate is 1.775. Now, the advantage of having a provisional rate is that you forecast out added extra costs, added extra base. And what that'll typically do is lower your indirect rate. Okay? And in this case, now you're coming in at a wrap rate of 1.589, which is very competitive, much more competitive than 1.775. So that's really the snapshot of the advantage of having a provisional rate. So then here's another example of a pricing matrix, and the other matrix, it showed how you build up that particular fully loaded rate. So now you're going to take the same loaded rate, and then you build in, depending on how many option years there are within the contract, build in estimation factors. I think in this case it's 3.5%, so that the government can see, okay, well, what's it going to cost period, and then my extended option years. Again, some of the advantages in developing provisional rates. Most important, you get competitive pricing. You have really advanced capabilities in estimating and forecasting. Once you develop provisional rates, they essentially act as your company budget. So even if you don't have an advanced accounting system, if you're able to develop provisional rates, you can actually see where you're over or where you're under every month. That's the beauty of developing provisional rates as well, is that you've already essentially built your budget. Able to compare actual versus target gives you the ability to monitor and to control costs. If your fringe is too high and you know you're accruing and expensing, let's say, bonuses at $20,000 a month, hey, well, you can reduce that accrual significantly if your rates are too high. Same thing with maybe your G&A costs. A lot of small government contractors and mid-sized government contractors really struggle with G&A. So this gives you the ability, if you want to be at G&A at 12% and you're really operating at 28%, it'll give you insight as to maybe you can control some of the costs, or you can even actually cut some costs. And sometimes it's an advantage, sometimes it's a disadvantage, the BCA interaction. BCA's radar, and you're in compliance, the more likely you are to win that type of work. So obviously, pricing and cost volume, it's all about following directions. That's pretty simple. If you can't follow directions, or you miss a certain piece within the cost volume, or how good the technical approach side is, most source selectors will go ahead and throw the RFP out. So we talked about advanced accounting systems and what the advantages of having an indirect rate report are now for you. Here's some limitations for QuickBooks and Peachtree. BCA, they will pass a QuickBooks system audit, but if your system isn't set up very thorough and you don't have, and the system is set up so that it's not very disciplined. One of the problems with QuickBooks and Peachtree is that you can go back into any month and modify a number. Most compliance systems require that the system be able to complete a hard close so that any adjustment that you had for a prior period will be done in that particular current period. Okay? The QuickBooks and Peachtree application really doesn't give you advanced reporting as far as indirect rates, cost reports, job summary reports, and those are pretty much things that BCA looks for when they do a system audit for you. Lack of automatic rate calculation. QuickBooks, you can extract the data out of QuickBooks and basically populate an Excel spreadsheet. Excel spreadsheets are fine, but sometimes they can be complex, and the more complex they are, the more prone to error. And most importantly is that you have to have written policies and procedures as a company to even start to go after really any kind of government work. Because at any point in time, BCA could just give you a memo and say, hey, we want to review your policy on timesheet. If you don't have that, you could be on their bad list. You don't want that. Okay, so that pretty much concludes the body of the webinar. I'm going to go ahead and turn it back over to Mark Stadler, and once again, I'm going to say thank you all for joining us.
Yeah, thanks a lot, Sean. It's a lot of great information. I hope you found it as beneficial as I did. So we're going to do one final poll before heading into the Q&A section, and we want to know that if you're on QuickBooks or Peachtree, what's the biggest challenge that you're currently facing with the application? Many people who come to us looking to upgrade to a Deltek solution say that, if they're able to modify the close months, it's something that Deltek, or something that BCA rather, is certainly raising the red flag about. So that's an important one. Actually the last option, no automatic rate calculation, can really be a burden on small companies, like Sean mentioned, building that out in an Excel spreadsheet. Once you get, with multiple tabs and macros, everything can really get quite complex. So I'm going to go ahead and leave this poll open for another 10 seconds or so. Let your responses trickle in, and we'll share it with the group. Okay, we're going to go ahead and close it, and we'll share the results with you. And kind of, to no surprise, 71% of you know automatic rate calculations. That's really a burden for small companies, as I mentioned. And so you'll definitely want to evaluate how that kind of fits into your whole back office strategy and see that, if you're looking for a more streamlined way, a more systematic way that BCA recognizes, you might want to think about bringing a solution that does that for you. And that's definitely something that the Deltek products have functionality for. So with that, we want to share a couple of resources that you can use as you're getting ready to do various accounting and financial management operations of your business. As Sean said, one of the things that you really need to keep in mind is to follow direction. So here are 5 great resources that are out there that really give guidance in terms of what accounting regulations apply to you, on how to sufficiently structure a cost proposal, and make your proposal really be reflective of what the government's looking for. So DCAA always make sure that you're up to date with changes that come out of there. They do update that pretty frequently, so you want to make sure that you're on the cusp of all those changes. As well as the third bullet there at the far too, it can be a little daunting to go through that, and I wouldn't recommend doing it after a turkey dinner because it'll probably put you right to sleep. But it's certainly something that you need to be aware of. And in terms of resources that we offer, if you are on one of the Deltek applications, we offer a suite of accounting training courses on those to really get you familiar with the core processes that are in each. So processing accounts payable, managing a general ledger, running payroll, things like that. For those of you who are out there on Cost Point, we actually have a blog dedicated to questions that you want to submit off the webinar, feel free to reach out to us at growahead@neosystemscorp.com, or here is the email address for Sean and I personally. With that, we're going to open up the questions here and get to some of the ones that were submitted. So if you haven't submitted your question yet, feel free to go with it. Yeah, and as always, we do have a couple questions about making the presentation available. If you give us till about Tuesday of next week, we probably will have the recording up on YouTube. And if there's any delay in that, we'll send you out the slides. But definitely keep an eye out for the recording, because that'll have the audience go along with helpful.
Right, so most of the questions were about the slide. There is a question about the rate calculation. Can you go back to that slide? Okay. Okay, so next question, of those sites that was listed, which site is best to see what compliance is required for small business? You can really go to the actually the SBA website, and also DCA.mil. DCA will be obviously geared towards all types of government contractors, but there are some advantages for small businesses, such as different certifications, 8A, women-owned, small disadvantaged business, veteran. And the advantage of that is that the SBA website will have instructions and basically a map of how you can get those particular certifications. When you get those certifications, obviously it gives you an advantage in winning some work, because in FedBizOps or any other opportunity websites such as that, some contracts are actually geared towards only women-owned business or veteran-owned business, for instance. All right, next question. With regards to the wrap rate, what is the target amount? I think so how I'm going to answer that question is that my interpretation of it, your target rate is essentially, again, what you forecast out. So typically, for me, I'd like to start to look at actual financials for the year around the October, November timeframe, and then really have last week of November and a few weeks into December to really build up what my forecasted costs are and what my forecasted revenue will look like. And then once you can establish that, then you'll be able to have target rate for your next year. So when you can establish, potential RFP wins and revenue, and you know exactly how many employees are coming in, you'll have your target rate. All right, so I think that pretty much wraps it up. Once again, I want to thank you all for joining us, and Mark will go ahead and send out another registration for the incurred cost compliance. Earlier, we definitely are looking at doing another webinar that's focused all about compliance and what different regulations apply to small government contractors. So that invitation should be going out sometime in the next week or two. You might actually see it coupled with the link for this presentation. So definitely keep an eye out for that. In the meantime, if you do have any questions about either the principles of government contracting or the services that we offer, feel free to reach out to either Sean and I. So once again, thanks for attending, and we look forward to seeing you on the next one.
Any of these videos where you see Max Timko, this guy over here with a smile on his face, you'll see him right there. Max introduces me on that first video. Any video you see with Max's face on it, Max is our PR guy. He's trusted. He's a great guy. He does all of our public relations. Any of the videos he's done where he explains stuff specifically, you can watch those if you like. That's all good stuff.
Mhm. You feeling better now? Oh, this shit is coming up soon, kid. Nah, the motherfucking shoot. They're having a shoot with black businesses. Oh, yeah? Yeah, damn right, Jack. Brown's Island parking lot near the bridge.
Look for the yellow flags. I'm saying, please wear or bring a product that represents your business for capture and advertising purposes. You know what I'm saying? You know I'm gonna be out that bitch like exclusive superhero. Then what y'all think we're gonna rock? I'm gonna do a tank top. But I'm gonna do the X's like I did on the jacket. I went in on that jacket. That shit was hard. I might do exclusive where I cut out exclusive and I'll get you to read out the exclusive. And I'll do a box and it'll be like I'm reading the goddamn the doorway part. Oh, that's how it's a box. Like a Supreme shirt. So you know she's gonna have just like last where it says spring. Knuckle Web Supreme hat. But I put exclusive on.